Hello and welcome to today's Premium Account Investor Signals Market Update for August 2016. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hein, Managing Director of Investor Signals, have 18 years of experience in the financial services industry and a current licensed securities and derivatives advisor. The format for today's presentation, we look at the macro update driving equities. We roll through the ASX top 50 stocks with a focus on FES 16 and FES 17 earnings. We look at the technical trends of portfolio allocations and conclude with the short-term market outlook. The Investor Signals Premium Account Service is a model portfolio of ASX top 50 stocks. We utilise call options to enhance portfolio returns, focus on effective ownership around dividend, ex-dividend dates, generating above average cash flow from the dividends and the call premium, while still looking for capital growth. It's all in a strict investment mandate, therefore suitable for your self-managed super funds, and importantly, the assets remain in your name. If you'd like to know more about the service, please contact me, Leon at investorsignals.com. Moving straight into a graph of the US market. Up on screen's a graph of the Dow Jones. Now, we've just concluded the second quarter 16 US earnings, and broadly speaking, S&P 500 companies have beat relatively low consensus earnings estimates, which is keeping the bull market intact, combined with the fact that you've got the BOJ providing additional stimulus. You've got the ECB continuing with their stimulus, and in particular sort of refocusing that around corporate bond buying. You've got the Bank of England lowering rates and likely to provide additional stimulus. So central bank policy still remains supportive. Global yields remain low, and we're in an environment where equities, I think, are likely to trade sideways, and any ongoing rally I really think is probably muted as a result of sort of low global growth. As we roll through the top 50 companies, we'll have a look at how that theme applies to the valuation of companies on the ASX and how we recommend utilising the call option strategy to enhance the returns. Before I move on to the top 50 stocks, up on screen's a graph of the 30-year treasuries in the US. The yields are continuing to trend lower here, so even in the face of what looks to be a high probability that interest rates will at least have one increase in the US later this year, we're not really seeing a whole lot of pickup there in the bond market, albeit it's worth noting that it has sort of bounced off its recent lows, but still far from an uptrend developing there in the context of the yield on US treasuries. Okay, looking at the top 50 index, we're just kicking off earnings season here in Australia now. We've had Rio last week, which delivered results in line with market expectations, just over $1.5 billion of profit. Suncorp delivered an okay result, albeit the market didn't like it at first, but sort of I think, given that underlying earnings are likely to grow maybe 2 to 3% over the next 12 months, the stock trades on a 6% dividend yield. We've seen money flow into that. And then we're just in the early stages this week of seeing sort of some of the bigger names with CBA out today. I'll chat more about the earnings as we roll through the top 50 stocks. I think the most important message here on the ASX market is we had been in a downtrend since May last year, and the market had been making structural lower lows and lower highs. During this period, we'd really been underweight resources and banks, and our focus had been on property trusts and infrastructure names as our overweight positions in portfolios. In the last month or two, what I started to say was that we're in the early stages of a rotation back into banks and resources, and we've seen that play out in particular over the last 4 weeks or so. I think that's probably ran its course, albeit that's the area of the market that there is potentially still a little bit more upside, but I think we're getting sort of close to an inflection point where this post-Brexit rally that the market's enjoying is probably getting close to the top, and we're in for a period of consolidation. But again, important to highlight here that we've got a bullish structure that's occurring. Any sell-off in the index back to around 5,200, I'd see that as a buying opportunity. On that note, let's go straight into the top 50 stocks, and I'll provide some brief commentary as we move through these. So AGL, we like this. The earnings really, I think, sort of met market expectations. A bit surprising the sell-off here that's occurred, but I think sort of this is a buying opportunity. It's worth holding the stock at these levels, selling a $20.50 covered call, collect the dividend, collect the call option. You're delivering 10% cash flow from a relatively low risk stock. I had warned for a while there that AGL is getting pretty expensive, up around $20. So it was always a name that we didn't see any capital growth in. But I think over the next 6 months, it mostly trades sideways. I see it trading within a range of sort of $19.50 to $20. Amcor, we continue to like this name, even following the recent earnings downgrade they had. But at this price level, the stock trades on about a 3.7% dividend yield. I think the company will deliver flat earnings. The stock will trade sideways around this 15 to 15.50 level. I think it makes sense to own it here and sell covered calls. Amcor hasn't yet reported its results, but so we'll come back to that in next month's recording. AMP, I think this now looks expensive up here on a roughly 5% dividend yield. Probably not much in the way of earnings growth over the next 12 months, maybe up to sort of 4 to 5% earnings growth. Puts a stock on a 5% dividend yield. Into FY 17, we're looking for around 40 cents of earnings per share, which is pretty similar to FY 16. I think the stock moves sideways in line with our view on the broader index. ANZ, look, the market's it's comfortable here, although the earnings were, I think, down roughly around 3%. The market's responding favourably to the turnaround in the bad and doubtful loan provisioning. And it seems to be closing the yield gap. So whereas it was trading sort of on almost 7% dividend yield, we're seeing this sort of come back in line with the other banking stocks. And I think sort of the ultimate target here is around sort of 27.50. It runs into resistance and probably consolidates. So that's our view there on ANZ. Worth flagging that it's moved into a higher technical structure. So it's worth sort of revisiting this on any pullback in the coming months, as it may be an opportunity where we see a sort of for the first time in over a year where any of these banking stocks have actually created a bullish higher high and higher low structure. So we keep that on the radar, and we'll revisit that as a buying opportunity maybe in the latter part of this year. APA Group, we continue to like this name. Trades on about a 4.5% dividend yield on this pullback to around 9.20. I think it's worth having a look at APA. ASX, we like this, but it's expensive, up at about 22 times earnings with about 4% dividend yield, maybe underlying earnings growth of 5%. Not sure there's too much more upside there left in the ASX. AZJ, I think the risk here is not much in the way of revenue growth, 100% dividend payout ratio. I think there's not much margin for error. We'll be looking at the result to see if the company's delivering on their cost out program. There's about $350 million over the 3-year period that they were stripping out in costs. So we're looking to see confirmation that that's happening. But I think we're probably only maybe 6 months away from the company being forced to revise that dividend payout. And in that environment, the stock's really only worth around $4.50 on our numbers. So I think this still remains on our radar as a potential sort of shorting opportunity in the market. BHP, so we continue to hold BHP in portfolios where we do. We've been selling the 22.50 covered calls to complement the income out of it. The stock pays, on these numbers, I have it tracking at around 2.75% dividend yield. So again, up to sort of 22.50, I think sort of captures any upside recovery there in BHP. Brambles, likely to come in at the lower end of guidance, just over $1 billion of profit, puts the stock on a fairly ritzy multiple, up at around 24, 25 times earnings and only about a 2.5% dividend yield. But given that the company's likely to deliver on that sort of 6% earnings growth, I think it's a fairly strong argument to say on a relative basis to other assets in the top 50, owning Brambles at this level and selling the 1350 covered calls over it makes sense. I don't see it doing sort of too much outside of that range over the next 6 months. CBA, again, as I mentioned, so I think net profit came in at around $9.5 billion, was up about 3% on the same time last year. They confirmed a $2.22 dividend for the half. Puts the stock on about a 5.4% dividend yield, in line with the view that the index has moved sideways. This post-Brexit rallies really ran its course. I just see CBA moving sideways from here. So to the extent that covered calls can be sold to complement the upcoming dividend, I think that makes sense. There's no point allowing for too much in the way of capital growth there on CBA. Coca-Cola, we're starting to see analysts upgrade Coca-Cola. We've seen some solid growth numbers out of, in particular, their water and non-sugar or non-carbonated drink sales over the last quarter or so. Obviously, the soft drink sales are still down. I think the number was about 3%. But on average, what this means for Coca-Cola is it should grow earnings at around about 5% per annum. In that environment, we could see the dividend sort of kick back up to around 45 cents on a full year basis. That puts the stock on around about a 5% dividend yield. I think maybe it trades between this sort of $9 to $9.50 level, but any opportunity to sell covered calls above that range, I think sort of just complements the income stream from the dividends there. Computershare came out with an earnings result today that exceeded market expectations. The market had priced in earnings falling by around 9%. They were closer to flat on the same corresponding period, and that was a good outcome for Computershare. I think the business still remains a little bit challenged, and for that reason, it's not one that we're looking for a lot of capital growth in. And to the extent that we own it, selling the covered calls, I think makes sense there over Computershare. CSL, I think this is still a standout, maybe somewhere in the order of up to 20% of earnings growth year on year. The company's continuing to buy back shares. It is expensive, trading up at around 30 times earnings, but if they continue to deliver that sort of 15 to 20% earnings growth, we see that EPS come down over the period ahead. We own it at lower levels, and I think that sort of still sits in most client portfolios as a reasonable position. Caltex, we like this name. I think the dividend yield on it is tracking at around 3.5%, and we're selling covered calls up at around $36.50 to $37 out into the back half of the year to complement that return. It's one of the few stocks that is putting in a high, low structure, and I think it's got the sort of capacity to trade up to around at least that $35 level. We're starting to see some of these property names just pull off their highs a little bit. I'd spoken in the last recording about the risks starting to build where these yields are compressing down to, in some cases, sort of low 3%, and I think that's just too expensive where you're not getting rewarded for risk. GPT is probably the exception there. It's one of the property trusts we continue to like, trading at about a 4.3% dividend yield. Should deliver around 30 cents of earnings per share in 2017, and I think sort of that makes it fair value at this price. So owning it and selling covered calls is the strategy there on GPT. IAG in the insurance space. So while Suncorp's insurance margins weren't too bad, I think at $6, IAG is pretty much full value, puts it on about a 6% dividend yield, and we're looking for around about 5% underlying earnings growth. So they're yet to report their result, but it'll be an interesting one to have a look at. But at these levels, I think it's pretty full value. James Hardie, I think on this sell-off, this is one that is worth putting on your watch list. So we're buyers of this again on any pullback to around this $20 level. We had owned it at lower levels, and we've sold covered calls over it. James Hardie will probably grow earnings something around 15%. Trades on about a 2.75% dividend yield. So it is at the upper end of the sort of valuation range, but over the next 6 months, I think it trades sideways. Still, the US housing market seems to be a bright spot within sort of a recovering US economy there. Lendlease, we we look forward to seeing the earnings results here. It trades on a pretty low multiple at the moment, around 10 times earnings, so the market's quite concerned about what the upcoming earnings result looks like. It's on about a 4.5% dividend yield. I think it can trade on a good result up to around $14.50. Don't see Lendlease doing too much beyond that. Medibank Private, so this is a name that we hold in client portfolios, so we own it at lower levels. We've sold the covered calls over it. Again, I think it's a defensive name, and really the way I see the market is having a portfolio of stocks that are likely to move sideways and their earnings are well underpinned is a suitable asset mix at the moment. So given that parts of the market of the top 50 are trading on a fairly high multiple, and you don't want to be completely overweight resources and banks, trying to complement the portfolio with stocks that have fairly stable earnings and collecting the dividends and using the call options to enhance the returns. To me, that's sort of the optimum portfolio mix in this environment. Medibank fits that. And therefore holding it at these levels and selling calls around the 320 level makes sense to me. Macquarie Bank, not doing anything there at the moment. Forward earnings likely to be somewhere around 2.1 billion in 2017. The stock's enjoying a recovery at the moment. You're seeing sort of US banking sectors, whether Morgan Stanley, Goldman Sachs, even sort of the larger Citigroup and so on doing well. And I think in that environment, Macquarie's obviously performing in line with the recovery that we've seen in the US investment banking stocks. At this level, though, for me, it's starting to get close to sort of full value short term, especially when you tie that back into the view on the index. National Bank, I think all the Australian banks seem to be fairly close to sort of full value in this recovery or in this bounce that they've had at the moment. It's interesting just the outperformance that we're seeing in ANZ and whether that's just can be put down to a relative closing of that yield gap. So whereas ANZ was trading on a much higher yield, a little more risk priced into it, there seems to be a little bit of repricing going on to bring that back in line with the other three major banks. Newcrest, so still with gold still continuing to perform well in an environment where a good part of the world is moving towards or has moved to negative interest rates, and Newcrest is a beneficiary of that. Origin at the moment, we're looking for a gradual ongoing recovery within most of these energy stocks. We see both oil prices and natural gas prices continuing to recover, and that should bode well for Origin. We're not likely to see a major shift in their dividend policy of around 20 cents. So again, to the extent that you own it, selling covered calls up at around 6.50, I think sort of compounds the cash flow return from holding the stock, and really allows for probably where the bulk of upside sits for Origin over the next, say, 3 to 4 months. Orica, we think this name is probably more something as a focus on the short side. We've seen the company sort of move to a progressive dividend policy, which provides shareholders with very little certainty around dividend, what the next half dividend result looks like. I think that'll disappoint. So we're looking for Orica to trade lower over the next 6 months. Oil Search, close to full value here, and it's worth taking the opportunity to sell covered calls over it. Qantas, so interesting that after it having a big rally over the past couple of years, we're seeing it move into a lower low, lower high structure. Hard to sort of pinpoint where ultimately the shorting opportunity will be, but whether it's between sort of 310 or 360, I think that's a range where Qantas starts to struggle a little. QBE, so we're not really doing too much here. I think this is really a play on a recovery in US bond yields. But it'll be one that we take a closer look at the earnings result when they come through. The company's fairly disciplined on a cost-out program at the moment, which is helping to underpin the business. But to try to put some numbers on where we see QBS trading about 13 times earnings on a 5% dividend yield, it's worth noting that the technical structure is still negative, but looking for it to really trade sideways and then gradually start to recover over the next sort of, say, 12 months. But again, that's going to require a fairly supportive backdrop for US interest rates beginning to gradually increase for the turnaround really to take hold there in QBE. Ramsay Health Care, so a little bit expensive for us, but we have had this one in the model, but at around 30 times earnings on about a 1.5% dividend yield. I think there's other areas of the market that are more attractive. Rio, as with BHP, we see a little more upside in these names, maybe to the order of, say, 5%, nothing much beyond that. And then it's worth looking to sell covered calls to complement the dividend return there. And I did speak about Rio's earnings result coming in about 1.5 billion, pretty much in line with market expectations. SCG is another example of where these property trusts have just got a little bit overcooked. So the stock SCG at one stage was trading up at almost 25 times earnings and had compressed down to less than a 4% dividend yield. We're now seeing the price pull back a little. I don't think you can expect too much as far as downside selling pressure in these property names. So they're probably getting close to maybe 5% away from sort of where they ultimately find support. So if we get a little bit more selling in them into next week, it's an area of the market that we're happy to revisit to look at reallocating capital. SEEK, I continue to like this name. I think the company can deliver around 10% earnings growth, and it's worth keeping this on the radar that any buying opportunity on the dip, I think it's worth adding SEEK into portfolios. Stockland, a little bit cautious here on a valuation basis, even though the company's indicated that they're growing earnings at around 8%. The yield's now compressed down to 5%, it's trading about 18 times earnings, and I don't think the earnings certainty is there in Stockland quite like it is with say, GPT, for example. Sonic Healthcare, so this is one of our preferred names on the pullback here. I think this is worth adding into portfolios, about 20 times earnings on a 3.5% dividend yield. But again, we want to complement this with a covered call up at around $23. But that's a name that's worth adding into portfolio. It fits that mix where we're looking for sort of fairly defensive income streams, where we're unlikely to sort of have major surprises to the downside. Santos, not doing too much there at the moment, but again, broadly seeing sort of a slow recovery in the energy space. Suncorp, I touched on that one where the earnings results disappointed the market at first, but on reflection, I think the market worked through those numbers. The insurance margins were okay, the banking division did okay, and from a yield perspective, the stock was sort of down, offering almost 7% fully franked dividend yield. We're now seeing that compress back down to somewhere around 5.3, 5.5%. And I think that sort of captures the full value and recovery here in Suncorp. Don't see it doing anything more than what it already has done. Sydney Airports, we continue to like this name, owning it at these levels and selling the 750 covered call, I think makes sense. On an annualized basis, the stock's delivering a dividend yield of around probably just creeping back over 4% there, around 4.25%. Transurban, so the trading now back over at about a 4% dividend, 4.2% dividend. So I think it's worth having this on your radar. On this sell-off, it's worth looking at it. The company's reaffirmed that they're likely to pay out close to 50 cents of dividends in FY 17, and from what I can see, that looks to be covered by free cash flow. So it's a bit of a surprising reaction that the market's had today, albeit that I've argued for a while that Transurban's getting pretty expensive. It's fully priced, and the only way to play these names is to really sell tight at the money covered calls and forget sort of trying to capture capital growth. I think the bulk of the rally's done in certainly in Transurban. Maybe less so Sydney Airports, but I think the similar argument still applies. I think Telstra is worth having a look at on this sell-off. So we rallied up to almost $5.90 thereabouts, and it's now pulled back to $5.50, $5.55. I think this is a buy on the dip opportunity coming into the result. We like Telstra on the basis that the company's going to announce detail around the return of $1.5 billion to shareholders. Treasury Wines has just been added to the top 50 index, and it's a buying opportunity right here at sort of $9.20 thereabouts. I think it should be added into portfolios and look for a rally back up to around $9.50, $9.75 before we think about selling calls over that. Westpac Bank broadly in line with all the other banks. I think the bounce is largely complete. I don't think there's an argument there that there's significant earnings growth. When you look at sort of what's happened with CBA, they've delivered 3% earnings growth. ANZ came in below sort of expectations, at least from a growth perspective. I don't see any reason to expect anything better from NAB or Westpac. Therefore, at around 5.5% yield, you'd have to say, even in a good environment, these banking stocks are largely likely to move sideways over the next 6 or 12 months. So to the extent that we own them, we're giving them a little bit more upside room and then selling covered calls just to enhance the dividend. So in the context of Westpac, I don't see that doing too much above $32. Wesfarmers, I've spoken about this one. We added it into portfolios at lower levels. It was good value down here at 39. I said don't expect it to do much more than $43. That puts the stock on about a 5% dividend yield, and I don't think you can expect much in the way of earnings growth here out of Wesfarmers, given the drag on earnings that the resource division will contribute. But it'll be an interesting result to have a closer look at. Westfield, I think this is a buy right now on this sort of pullback that it's having, and it's probably one of our preferred property plays. Owning it here, collecting the upcoming dividend and selling covered calls makes a lot of sense there in Westfield. Woolworths, I don't think they report their result for another week or two, and we're looking for some further confirmation around the sell down of their home hardware business and any detail that they may provide around Masters. But the turnaround's slow, but it is happening within the grocery business, in general food and liquor. Assuming that the company sort of delivers on their guidance, on their revised guidance, I think Woolworths trades at about 17 times earnings on a 4% dividend yield. So in that basis, we'd have to say it's fairly full value in line with what the current earnings estimates are. But if we get any positive surprises on the sale of the hardware assets or any other restructuring news in general, we could see an uplift in Woolworths. But we'll keep an eye on that upcoming earnings result. We don't have covered calls over Woolworths at the moment, and keeping some exposure there to the potential that there may be some bullish sort of news in the market around the restructuring. Woodside Petroleum, full value where it is at the moment. And the stock really trades at about a 3.5% dividend yield in an environment where oil sort of struggles to really break back above $50. I don't see Woodside doing too much more other than trading sideways at the moment. And obviously there's news in the media about a potential meeting with OPEC that not necessarily cuts production, but attempts to freeze production. And we've seen oil sort of bounce from $39, $40 a barrel up to $45 on the prospect of that meeting taking place. Last time that was really a non-event if we look at how that unfolded earlier in the year. So I'm not sure that you can read too much into that. And for that reason, I think the base case is oil trades around this $45 to maybe $50 a barrel, and in that environment, you'd have to say that Woodside trades sideways. It doesn't, therefore, add a huge lot of upside leverage for someone like BHP, which is why we sort of have a view that around $22.50 in BHP is an opportunity to sell covered calls. And when I've covered the other energy names in the context of oil search again, taking that opportunity to sell the covered calls there makes sense as well. And then finally back to the index. So to try to summarize where we're at, I think the market's had a fairly substantial sort of post-Brexit rally. I think the US earnings have been okay. I think ASX results, barring a handful of companies that might grow earnings somewhere in excess of sort of 5%, the bulk of the companies will be sort of flat and that's what we're starting. That's certainly what we've seen at the moment. And given that the valuations are fairly high and yields are compressed, I don't think there's a reason to sort of feel that the market's really going to tear away to the upside. So, we encourage clients to position their portfolios around names that can remain defensive in a period where volatility, if it was to pick up, and then obviously drive the returns from the covered calls, the dividends and the franking credits. Thank you for listening in. If you'd like to know more about the service or have a chat with me about the market, I'd certainly like to help you out with managing your portfolio, and you can contact me using the details on screen.